Imagine this, you are watching another intense cricket match, but this time the players aren't just reacting, they are strategizing. Every move is calculated. They are balancing the risk reward just like you should do as a trader. That's exactly how iron condors and iron butterflies work in option market. Today I'll break down these simple concepts in the simplest way possible. How do they work? How they differ from straddles and strangle? When to use them? If you are looking for steady profits with limited risk, this one is for you. Let's start with Iron Condor, a strategy that gives you breathing room. It's like spreading your fielders wide in the cricket to control the game. Iron Condor is equal to short strangle plus protective wings. It's a 4-leg option strategy designed to profit when the stock stays within the range. Here is how it works. There are 4 legs as I said. First, sell a call at 2100. Sell a put at 1900. Buy a higher call at 2150. And buy a lower put at 1850. If the stock stays between 1900 and 2100, you keep the entire premium. Your losses are capped if the stock goes beyond 2150 or below 1850. Unlike a short straddle or a strangle, your maximum loss is defined upfront. This makes it ideal for the trader who wants steady returns without sleepless nights. Now let's talk about Iron Butterfly, a more compact view of Iron Condor. It's like placing your fielders around the batsman aiming for precision. Iron Butterfly is equal to short straddle plus protective wings. Same 4 number of legs, but the difference lies in the strike price. So set up example. 1. You sell a call at 2000. 2. You sell a put at 2000. 3. You buy a higher call at 2050. And 4. You buy a lower put at 1950. You profit if the stock stays within the close range of 2000. This strategy collects more premium but requires greater accuracy. Why choose it? You get a higher potential profit, but the break-even range is tighter, so the stock must stay in the center strike. Let's compare them head to head. Iron Condor is playing safe in cricket, defensive but effective. Iron Butterfly, betting on a perfect Yorker, higher risk, higher reward. Both are excellent range-bound strategies for low volatility environments. The key, don't just predict the stock direction. Predict if the volatility lower than what market expects. Once you do that, these tools can become your best friend in option market. For now, focus on understanding the concept. Later we will show you how to deploy these strategies in real world volatility setups. Let's lock in your learning with a quick quiz. Question number 1. What is an Iron Condor strategy in option trading? A. Buying 2 calls and 2 puts with the same strike price. B. Selling and buying options with different strike price to create a range. C. Only buying call and put options. Or D. Buying all call options at the same strike price. The answer is B. Buying and selling options with a different strike price to create a range. Question number 2. What is the main advantage of Iron Condor strategy? A. Unlimited profit potential. B. Limited risk with a known maximum loss. C. No risk at all. Or is it D. The stock must move significantly for the profit? The answer is B. Limited risk with a known maximum loss. Question number 3. What is the key difference between Iron Condor and Iron Butterfly? A. Iron Butterfly has a wider profit range and collects less premium. B. Iron Condor has a narrower profit range and collects more premium. C. Iron Condor has a wider profit range but collects less premium, while Iron Butterfly has a narrower range but collects more premium. Or is it D. Iron Butterfly involves only selling call option? The answer is C. Iron Condor has a wider profit range but collects less premium, while Iron Butterfly has a narrower profit range but collects more premium. Question number 4. In an Iron Butterfly strategy, when do you make profit? A. When the stock moves far away from the strike price. B. When the stock stays very close to the strike price. C. When the stock moves significantly above or below the strike price. Or is it D. When the stock stays outside the break-even range? The correct answer is B. When the stock stays very close to the strike price. Last but not least, question number 5. Which strategy has a wider profit range but collects less premium? A. Iron Butterfly. B. Iron Condor. C. Short straddle. Or is it D. Short strangle? You guessed it correctly. The answer is B. Iron Condor. Drop your quiz score in the comment. I'll personally check them and help you guide to your next step. If this video helped you to simplify the iron condors and iron butterflies, share it with someone who is ready to move beyond basic strategies. In our next video, we will understand how to do trade research. Until then, keep learning, keep winning.